I guess the good news is we're heading down the road of a new platform here and new ways of connecting with our members. The bad news is that it's being pushed on us by the situation of the coronavirus. So I hope everyone's well and safe, and thank you for joining us today. Recently, the FSAA has spoken about training our members in terms of being accountants of the future and the skill sets that are outside of your normal domain. And we thought bringing some topics to you that are slightly specialized and in this area would be very valuable to the membership. And we felt it was important to stay in touch during this time. So without further ado, we'll start into today's session. We have a guest presenter from Bloomberg, Nick Burrough. Hopefully, Nick, if I pronounced your surname correctly.
Close enough.
Nick has spent a very long time in the financial market space, 27 years in fact, and is 5 years with Bloomberg and is a fixed income market specialist. And today's topic will be touching on the fair value of interest rate derivatives, and it's quite a niche area, and I'll let Nick obviously expand into that further. Just before I hand over to Nick, we'll do a little plug for some upcoming webinars that we have. So next week we have Raid Muslin from Finity, who will look at shocks in terms of catastrophes, bushfires, storms, and recently COVID-19. So that'll be interesting as well in the pipeline. And also we have flagged a bit of a specialist touch on tax basics towards the end of May 28th. But please stay tuned because we will hopefully schedule more of these going forward. The other thing we are exploring at the FSAA is trialing our courses via this Zoom platform. And we have one booked in on June 15th, which is the GI Intermediate course. So please, if you're interested, join us for that session. Back to today's, Nick. We really appreciate you taking the time to touching on this subject with our members. It's great to know your neighbours, and thank you to Di and for putting you in touch with us. Really looking forward to this presentation today. And if there are any questions from the audience, I believe you should be able to either post a message or raise a hand. Di might have to correct me on that. There's a chat function, Q&A function. We'll monitor that, and hopefully we can flag those for Nick as we go. So maybe over to you, Nick, if that's
great.
Okay.
Thank you. Thanks, Stephen. Just a bit more of an introduction. I've been at Bloomberg for 5 years, but my first career was actually in market making and risk managing interest rate derivatives for various banks. And although it sounds very interesting and glamorous, the trading, but the reality is that I actually found it quite dull in large parts. And I thought the actual technology piece behind the valuation and the pricing of the derivatives, I found it more interesting than the trading quite often. And so I'm not a quant, and I'm not really a pure technologist, but by trading standards, I was probably considered a bit more technical. And I got distracted and heavily involved in a lot of IT projects. And also around that, I think today, I hope I hit the mark, but if I don't, I'm definitely contactable directly if you need to be. And I'm happy to try and do some follow-up work to narrow in on whichever area is of most interest, because I think there's such a broad range of people who can be involved in interest rate derivatives. There can be quants who want to go very deep and very technical very quickly, and then there's a very high level. Today, I've tried to mix it up with what I think is a bit of historical context and some themes. So if it starts out as being a bit slow, I do believe that it gets quite technical later. And I hope I don't lose everybody at that point. And definitely at the end, I'm going to give you just some sort of like what I think are the big themes and a bit of a look forward. But if we look at interest rate derivatives, in the very early stages, I think a lot of traders and banks probably are so new and the derivatives market so old, they really don't think about the derivatives market in the very conceptual stage that it was at back in 81, when really all an interest rate derivative, interest rate swap is think of it as just being a back-to-back loan and deposit. So in this example here, World Bank could borrow in US dollars and IBM could borrow in Swiss francs. The problem was IBM didn't want Swiss francs, it wanted US dollars. And World Bank wanted Swiss francs. So once IBM and World Bank met, which was actually via a bank connecting them, they kind of said, look, you have what I need and I have what you need. We need to swap that, okay? If IBM goes to the US dollar market and World Bank goes to the Swiss franc market, they worked out it would work out as being expensive. The Swiss franc investors really liked IBM, and so they were happy to buy that bond. And so the arbitrage, if you want to call it, was for World Bank to borrow in US dollars, IBM to borrow in Swiss francs, and then World Bank and IBM to do a swap. Now, there were no swap systems, there was no derivative valuations, there was no ISDA swaps contracts. It was just back-to-back loan and deposit. And as these back-to-back loan and deposits traded more and more often, they got bundled together and said, why don't we package them together and call it a swap and have its own contract? And that is the formation of the swaps market. Now, this, if it was, and there's a bit of conjecture about whether this was the first swap transaction, a far more common swap would be where someone borrows fixed and someone else borrows floating, but they really want to swap that profile. So perhaps somebody is able to issue a bond which is fixed rate, but they really want a floating rate borrowing, and somebody else is able to go to a bank and borrow floating. So they could meet. Now, what happened with these contracts, which are bundled, is they started to trade in their own right. So people realized that as soon as speculators and banks and funds started to trade these contracts, we needed systems to value these contracts. And that's where swap valuation systems started. Now, if we think about a bond, a simple bond, we don't really need much of a system to value a bond because the market establishes a price or a yield, and then that is the valuation, much like Westpac equities. You don't need a system to value Westpac stock price every night because the ASX tells you where it is. When you have a portfolio of derivatives, you don't have an individual price for every single trade. You need a valuation system to value the whole portfolio. Now, the bond yield formula is very, very simple. It assumes that every coupon you get on the bond, you reinvest at that yield, which may not be possible because the yield curve may not be flat. So what happened was the market started to bootstrap what is called swaps curves. And in the very early days, the simplest bootstrap, and if I'm happy to share this Excel with you. If you look at the idea of that, if you have a 2-year swap with 2 coupons, one at 1 year and one at 2 years, to get the discount factor at 2 years, you need the 1-year discount factor. So to get the 2-year discount factor, you need the 1-year discount factor to discount the first cash flow, and then you only have one unknown, and you can solve for the second discount factor. When you want the 3-year discount factor, it has 3 coupons. It has one in 1 year and one in 2 years. So you need the 1-year discount factor. You need the 2-year discount factor. Then you only have one unknown, which is the 3rd discount factor. Once you want to build the 4th discount factor, you need the 1-year discount factor, the 2-year discount factor, the 3-year discount factor. And this is why it's like doing up your shoelaces. This is why they call it bootstrapping. This example here is so simple that if you showed it to a bank, they would say we don't use systems like that. And that's what I will explain later. This is just for illustration, and I can share this spreadsheet with you later. So that was the start of bootstrapping. Now I've got a number 1 up here. There's going to be 5 circles with numbers in about different themes and topics. So we're on the first topic here. This is how people built swaps curves in 1985 through to 1990. Okay, simple bootstrap. The problem is, on an interest rate swap, you have a fixed leg and a floating leg, perhaps. When I build this swaps curve here, I don't even look at the floating leg. It's just about as though I'm bootstrapping a bond curve. The problem is that people built one swaps curve per currency, one for Swiss francs, one for euros, and one for sterling. And if you were building a swaps curve for sterling where you had fixed coupons on one side, the problem is you have different rates depending on what the floating frequency is. If I show you here, let me propose something to you. Let's suppose you want to lend money for 1 year and you don't need the money for 1 year, and the RBA is on hold and there's absolutely no risk of the RBA moving rates. You have some choices. I can lend to Westpac for 3 months. At the end of 3 months, I can get my money back and I can lend again. And at the end of 6 months, I get my money back and now I can lend again. I can do that 4 times across a year. Alternatively, I could lend to Westpac for 1 day, get my money back, lend to Westpac for 1 day, get my money back. Now, if you know the RBA are not going to move rates, then there's a level at which you're ambivalent between the two because they will end up with the same cash at the end of the year. The problem is, if you don't like Westpac credit after a month, you have to wait another 2 months to get your money back. That's if they don't default. And then you lend again, and you may choose another bank because you're worried about Westpac's credit. When you lend for 1 day at a time, every night you've got the choice to change who you deposit your money with. So the rate for 6 months and 3 month lending is materially higher than the rate for 1 day lending compounded over that time. And this spread between these liable and risky curves and these risk-free curves with overnight rates exploded post-GFC. And derivative systems before GFC for many banks had one swaps curve for all of the floating rate references. So if you did a sterling swap, which was fixed versus 3 month reference rate, or fixed versus 6 month reference rate, often you used the same curve. So you had one curve per currency. And all of the Australian banks were in this situation in 2008 when I first came to Australia. In London, the largest bank that I worked for was RBC, Royal Bank of Canada, which was a pretty big swap house. And we did not have multiple curves per currency, but we did recognize that there was a basis spread. And in sterling, where I was a market maker, we estimated it was worth 1 basis point, tiny, because banks were considered relatively low risk pre-GFC. Now, the second revolution, because we've got this blue circle here with the number 2 in it, is that post-GFC, you'll see in this blue box, the spreads were all very low and very tight between, here I've got 3 month US dollar LIBOR versus 3 month US dollar OAS. So effectively 3 month lending versus 1 day lending every day compounded up. Post-GFC, all the banks and all financial institutions rushed, if they weren't Goldman Sachs or JP Morgan, because they had this in place, to implement many swaps curves per currency. So number 2 is like the second revolution of swap pricing, which is let's have multiple swap curves for any one currency, depending. And here I've got euros, and in Bloomberg we build a swaps curve for trades, derivatives trades that reference 1 month Euribor. We build another curve for trades that reference 3 month Euribor. We build another curve to reference 6 month Euribor. And we build actually a curve that references 1 day. It's not Euribor, it's now Esther. It used to be only another reference rate. So this is the second revolution in swaps pricing, which is the multiple curves. Now, it's simplistically, the step is from the first column here, single curve, to the second curve. But if I go to the third, and this is an example of something I don't want to go into too much detail, but you might be interested. For the big investment banks who really specialize in making prices in this, they need very big computers to be able to build many curves simultaneously. And in Excel speak, it's like a circular reference. It's not a simple closed form solution. It's not anywhere near this. This is a dumb example to prove a point. In the practical world, it's very complex and very expensive computationally. And I can show this example with you here, but in essence, it's a complex problem in the modern world to do the full investment bank valuation of derivatives. So I'm going to call this number 2, the forecast curve revolution. So in the early days, we had one curve per currency. Then we realized we need multiple curves for each currency. The third revolution I'm going to talk about is around how do we discount the cash flows? So we know we have to estimate cash flows in the future for floating rates like LIBOR, but how do we NPV those cash flows back to today? Now, in both of these stories so far, we assume we use one of these swaps curves to discount back all of these cash flows. We've got these multiple curves. The third revolution I'm going to talk about is people realize that if you trade these derivatives on a professional basis, you actually have collateral agreements. So it means that if you lose money on the derivative, you actually have to pay that money tomorrow to your counterparty. You don't have to wait for all the coupon payments because you have a collateral agreement in place. It means you don't have credit risk with your counterparty. And another type of collateral is that it goes to a clearinghouse like LCH or CME. Now, that means that your derivative transactions actually are what is called self-funded. That means that if you make money, that money comes in the door today, not in the future, through the collateral agreement. And these collateral agreements and clearinghouses, when they give you the money, you have to pay interest on that money. It's yours, but you owe interest on it. You're paying interest on it, and that interest is at the overnight rate. So the fair discount curve for derivatives is a curve that forecasts the overnight rate for derivatives. Now, I'm going to touch on this a bit later. There is a school of thought which I dismiss completely, that if you are not collateralized, then you should not discount those cash flows on that curve. And that is a myth which I'm going to dispel later. And one of the reasons is that all of the data that we consume into our systems, from Westpac and Deutsche Bank, Intercapital brokers and Tullett Prebon, all of this professional market that trade actively in these contracts, all of that data is collateralized data. So even if you were a corporate and you weren't collateralized, the data that you take from the market to put into your treasury risk management systems is collateralized data. So you have to value it in a collateralized world and then adjust for it later. Say, look, I'm pretending I'm Coca-Cola Amatil, I'm not collateralized, I have a load of derivatives, I valued them in the system as though I was Goldman Sachs or JP Morgan. Now I need to make an adjustment, and that adjustment is offline, and that is what we will touch on as being XVA. Some people think that what you do is, as a starting point, you discount on a risky curve, i.e. a LIBOR curve. That is actually not true, and it's something that I've been working with the Big Four accountants about, trying to set a standard valuation for all player types. This is just a post that I put on that. It seems there is much discussion currently on the fair value of interest rate derivatives across player types, specifically around on what discount curve to use. It is not an arbitrary choice. The risk-free valuation is the same for all player types from which an XVA adjustment can be made. The concept of discounting on a LIBOR swap curve has no theoretical justification, but has become common practice for uncollateralized player types. For the flat earthers who believe LIBOR discounting you might struggle past the 1st of January 2022. And the reason I mentioned 2022 is LIBOR stops on the 1st of January 2022. So if in your derivative valuation framework at the moment you do discount on a LIBOR curve, you will be forced to go over to an OIS curve anyway. So it's no longer so much a discussion, it's a fait accompli. Now, we do allow us within Bloomberg to discount on a LIBOR curve or on an overnight index curve or on a risk-free curve. And that has caused me a lot of angst trying to intermediate between different player types, trying to come up with fair value evaluation, which is why I wrote that LinkedIn article, to try and bring all player types together. Most common situation is actually between a corporate and a bank, and they're arguing about fair value, and the bank is discounting on an overnight index swaps curve, i.e. an interest rate swap where the reference rate is a one-day rate. And the corporate has a valuation where he uses a different swaps curve to discount back the cash flow. And if you can see here, in effect, banks are discounting all the cash flows on this red line, and the corporates are discounting on the purple line, and that's the cause of the difference in valuation. Whereas what I'm advocating is that everybody discounts on that red line, and if you don't do it now, you're going to get forced to do it anyway, so do it now. And then we have this very standardized valuation for interest rate derivatives. And I was actually speaking to one of the big 4 audit firms the other day who are trying to write an internal process, because one of the things the audit firms struggle with is such a large turnover of staff is one person could do it in a certain way for a year because he works in that part of the business, and they could have a policy, and then it could all fall apart later because someone else comes along. The other organization that I have worked with to try and come up with standardization around processes is actually the ATO. It was actually around transfer pricing, but within transfer pricing, the use of derivatives to convert borrowings in one currency over to another, much like IBM and World Bank, if you're going to use derivatives in that calculation, then you need a policy and a framework around to do it. So I worked with the ATO and said, look, if you say you're going to use cross-currency swaps to synthetically convert borrowing from one currency to another in order to establish transfer pricing costs, you actually need to go a bit deeper, because you're going to get into this argument where you have an accountant, a corporate, and yourself in a triangle, and you don't have an agreed policy or methodology. So the third revolution, if you like, is around that discounting. So we had simple world, one curve. Then we had multiple curves because all of these indexes trade at different credit spreads. And then the third revolution was this discounting revolution, where everyone's decided they should discount on an overnight index swaps curve. Now, that kind of brings us fairly through to where people are valuing best practice today. But there is a massive, massive event, and I'd call it the biggest change in fixed income financial markets possibly ever. I'm thinking ever, and that is the end of LIBOR. So I'm sure your institutions will have working groups around how to transition away from US dollar LIBOR. And because LIBOR has credit risk in it, and if we migrate from LIBOR down to a curve with a one-day rate, there's going to be this unfair spread transition. So we need to think, how do we fairly go from LIBOR to one-day rates? The first thing is we need lawyers to work through the contracts, and then we need counterparties to agree with what the new contract looks like, and then what's the fair value at which to transition. Now, ISDA, the International Swaps Dealers Association, they've said, well, everything that's under our contracts, we're going to come up with a protocol for the migration. And there's two migrations. There's two factors to the migration. The first one is if I have a 3-month LIBOR and I want to go to a 1-day rate, how do I do that? Because a 1-day rate, it makes no sense to observe a 1-day rate, but to use it for 90 days. And they did a consultation, and if you look at this green blocks, the compounded in arrears, the vast majority of market feedback was, when we get rid of 3-month LIBOR, which applies for 90 days, we're going to observe the 1-day rate many, many times across the 90-day period, approximately 70 times, and compound up the interest and pay it in arrears. So term LIBOR, 3-month LIBOR is going to be replaced with compounded rates. But if we compound that 1-day rate, there's a fair chance it's going to come out much, much lower because it's got no credit risk in it. So the second part, the spread adjustment method at the top, they need to come up with what the fair credit spread is. And Bloomberg is going to do both of these calculations for ISDA. And that fair credit spread is going to be the average of the credit spread over it's actually going to be the median of the credit spread over the last 5 years. Now, I know the last 5 years today, but this is not happening until the 1st of January 2022. So I cannot tell you what this credit spread adjustment is going to be yet, because I only know 3.5 years of that time, that data set. So this big migration that's going to happen, we don't have all of the data yet. But Bloomberg's going to start publishing that data as though it was May and June this year, so people can look at the data. But the data that really counts is the data at the end. So there's going to be a massive, massive migration of hundreds of thousands of derivatives contracts away from 3-month LIBOR to this 1-day risk-free rate. And this in itself is a whole webinar and multiple webinars. If I had an hour to talk about LIBOR transition, it wouldn't be enough, and I'd have to go at quite a high level. So this is the fourth part, and this kind of takes us to a new world where instead of having all these multiple curves of 6-month LIBOR, 3-month LIBOR, 1-month LIBOR, 1-day rates, perhaps all the LIBORs go, and we only have one curve per currency. So potentially we've reached peak complexity in interest rate derivatives valuations, where we started with one curve, we ended up with multiple curves, we discounted on one of them, the OAS curve, coming back to just having one curve. Now, in Aussie dollars, the IBOR rate, BBSW, that is not planned to end. So the multiple curve world is going to stay in Aussie. But for a lot of currencies, particularly sterling and euros, we're going to collapse back to one world. Now, that may be simpler in the long run, but there's a huge amount of work to do that transition. So that's my fourth blue circle. It's forward-looking, and it's about how we've got to this peak complexity, but actually, with a lot of expense in IT spend, we're actually going to go back to potentially a simpler world. Now, let me go to a separate topic, which would come under the banner of also being a webinar by itself. With interest rate options, swaptions, and caps and floors, there's really only been one revolution since its inception. So let's suppose the interest rate swaps market started with IBM and World Bank in 1981. The swaptions market would have started in the late 80s. In fact, I started work in 92, and the firm that I first worked for was a heavy trader of interest rate swaptions. And unfortunately, it dealt a lot with local authorities in the UK. And there was a big court case where it was felt that the local authorities had been trading these contracts ultra vires. And so all the contracts were torn up and at a huge loss to the banks. So I remember in 92 looking at this product in detail. But in the early days of all asset classes, the valuation of options used Black-Scholes. But there is a problem with Black-Scholes. Black-Scholes says, I don't know what the price is tomorrow, but it could be 1% higher or 1% lower. And then it says, I don't know the price in 2 days' time, but it could be tomorrow's price, 1% higher, 1% lower. The problem with this is, if I give you Westpac shares at $15, if I say they can go down by 5% a day, they will never, ever go to zero. Because 5% of a positive number is a positive, it never goes negative. And that is fine for absolutely every asset class except for interest rates and oil. Because oil, I don't know if you saw, but oil on the very front contract went to minus $40. The May contract traded at minus $40. You had to, for someone to take the oil off of you, because no one's flying and no one's driving as much, you had to pay someone. But broadly speaking, all asset classes cannot go negative apart from interest rates. Foreign exchange cannot go negative. Stocks and shares cannot go negative. And excluding this extraordinary move in oil this week, commodities can't go negative. So when the Black-Scholes equation was developed in the 70s by Fisher Black and Myron Scholes, it was kind of breakthrough. They got a Nobel Prize for it. However, when interest rates start to go very, very low, the Black-Scholes volatility starts to go very, very high. So if interest rates, let's take BBSW, which is fixing at about 20 basis points. Let's suppose you want a floor at zero to buy an option on interest rates at zero. It doesn't matter how high you put your Black-Scholes volatility, it will never compute. So the revolution in interest rate options pricing is to dump Black-Scholes and to move to a normal model. Because interest rates, to say that interest rates are 10% and they can go up and down each day by 10 basis points, well, that's a better assumption, because eventually rates can go negative. So that is the one slide deck for interest rate options. And the world is broadly migrated for the major currencies, euro, sterling, yen, dollars, Swiss, Scandies. But emerging markets with higher rates have not done that migration. And it's actually very tough to move infrastructure for a market away from something that's embedded, because all of the banks and all of the brokers and all of the customers are exchanging data daily in Black-Scholes language. And then to rebuild it across hundreds of institutions is very, very difficult. And within the terminal at the moment, we're using normal for as many currencies as possible. And I'm kind of speaking to emerging markets and saying, if you're going to build your infrastructure in Vietnam for trading interest rate options, use the normal model. You may have high rates now, but you never know how low they can go. They said oil couldn't go negative. Once again, this is another subject that is a whole discussion by itself. So everything so far has been about the fair value of interest rate derivatives for all player types in what I call a risk-free world. So it does not take into account adjustments for the credit risk of your counterparty or how you fund the trade. So it's a framework where everybody is the same, and then you make adjustments. Now, the number of adjustments that people make has grown over time, and it's become a real industry in itself. And in the way that I think there is very good best practice principle about valuing interest rate derivatives, the adjustment you make to the risk-free price is far more difficult, and there's far more conjecture between player types around that. And here I've listed the 5 that I know of. I'm sure somebody somewhere's got another XVA, but these are broadly the big types. And the first one is, if you are not collateralized and you valued your derivative using the standard risk-free valuation, you then have to factor in how you fund that trade. So that's the funding valuation adjustment. It assumes that perhaps for every cash flow that you project in the future, that you have to go and actually raise the money to make that payment, or vice versa, you might be receiving a payment and where you would pay for that. So that's your funding part. Then you have the major adjustment. Now, the accounting firms would, for the majority of corporates, insist that they they include CVA. And it's great having a derivative that has made you loads of money. So you may have received fixed before COVID-19, and now your derivative is worth millions of dollars because the interest rates have collapsed and your derivative is the right side. But if the person that you traded with is not there to make the payments, then you won't receive the profit. So you need to adjust your valuation for accountants to say, well, perhaps Westpac aren't there. And we have models that calculate the probability of default for these institutions, and credit default swaps are a source of data that can be used for that. Now, the flip side, and this is a very contentious, I find it intellectually quite tough to get my head around, is let's suppose we had Westpac versus Virgin Airlines. Westpac is kind of pretty safe institution, and Virgin Airlines is less safe. If Westpac, and let's say it was at the beginning of the year when Virgin is riskier but not in bad shape, Westpac could charge a lot of CVA on their balance sheet for trading with Virgin because they see Virgin as being risky. Virgin could look at on their balance sheet and say, Westpac's pretty safe, we're not going to charge much credit. So Westpac could charge $1 million of reserves against Virgin, and Virgin could charge $50,000 of reserves against Westpac. The problem with that is you kind of have a mismatch. In a perfect utopia of derivative valuation, everything is zero sum. There's no value creation, there's no value destroyed. So if PwC audited every firm in the world, because there was only one auditor, they'd be able to add up everyone's bits and pieces and it all summed to zero. All the risk-free valuations of the derivatives matched, and then all the CVA DVAs matched. So what actually happened, particularly with banks, was they not only charged the provision, the credit for their counterparty, but they actually had the benefit of their own credit. And that's quite an extraordinary concept when you think that in the GFC, when Morgan Stanley got downgraded and was really having issues funding, they made a lot of profit because of their DVA, which really is quite a difficult thing to get your head around. Because their credit deteriorated, their profit went up because this DVA adjustment increased. So you've kind of got to balance conceptually, is the utopia of having all the balance sheets square off and match each other, does it outweigh this kind of weird situation where your credit deteriorates but you make a profit? Now, the DVA for many corporates is much lower than CVA, and on a materiality basis, I think a lot of corporates just charge CVA. KVA is very much applied to banks, and the same for MVA if you're cleared. But this is a whole topic that we can go into in more detail, but it's that kind of adjustment piece to the fair value of derivatives. And I'm going to kind of summarize here. I can't see any questions, but I hope there's going to be some questions at the end. If I had to put like principles of best practice valuation, now the overriding, I'm a purist and I'm an interest rate derivatives guy. The overriding factor is always materiality. So I go and see corporates and I say, I think I know what best practice is, but you may not need to follow it because it's not material to you. But best practice is absolutely to use multiple swaps curves in each and every currency, one per every index that you reference. Typically in major currencies, that would be a curve for 6 months. Let's do Aussie, 6-month BBSW, 3-month BBSW, 1-month BBSW, and the 1-day reference rate. Discounting on which curve? Discounting on the overnight curve is best practice. And I'm getting consensus now from auditors that is fair. And it's best practice if you're a corporate and you're uncollateralized, and it's best practice if you're Goldman Sachs and you are collateralized. The third one, if you use Black-Scholes for valuing interest rate options, which many systems still do, just be very, very careful. It's not best practice. And if you have options of low strikes, you can get material misvaluations. And if you have options of negative strikes, And seeing as Swiss franc and euro rates are minus 50, 60, 70 basis points, negative stripes in Europe are the new normal. You won't be able to value them at all. So Black-Scholes has failed. And once you've done the first three principles, the sweeper is everything you think that's been missed, you chuck into XVA and run that again, which is a very messy world and a whole new subject. So to run through the sort of historical bit and the evolution, interest rate swaps, cross-currency swaps, they can be viewed as back-to-back loans. And originally they were booked in loan systems. There was no derivatives contracts, there was no derivative systems. The bond yield formula doesn't work well for valuing derivatives, so we had to build mark-to-market derivative systems, dedicated mark-to-market derivatives systems. The earlier systems had one curve per currency, but this didn't work well as time went on, and GFC really exposed it, and so we had to build multiple curves per currency, and building that in a really sophisticated arbitrage-free fashion is computationally expensive. You can take some shortcuts if you're not Goldman Sachs or a market maker. And then following that, the discounting discussion, what curve to discount on. The growth of XVA, from a simple CVA adjustment through to all these XVAs to compensate for various other risks. And then this thing that's ahead of us now and consuming a lot of energy for all financial companies around liable transition. So all of the historical growth of swaps building, and maybe it all collapses away and we go to this beautifully simple world where we have one curve per currency, or in the case of US dollars, maybe you've got a couple one-day rates like Fed funds and so forth. Now, I think that is half an hour-ish, and I've got a theory that no one listens past half an hour, and I hope that there are some questions, Stephen.
Just monitoring the Q&A. There's been no questions typed in there. Just flagging for Di, and maybe we can take everyone off mute if possible, so we can speak to it as well. But in the interest of, while we're waiting for any questions that might come through, just often in the accounting world, we might be the recipient of the valuation, and this is absolutely fascinating information to understand how we get to that. Is there any common pitfalls that we should look out for, or quick ways we can sense check what we receive?
Look, I mean, I'm not here to plug Bloomberg. I do a lot of sort of collaboration with associations and stuff, and I'm very interested in this topic. So I'd say to anyone listening today, if they just, it's an interest of mine. So I've got no axe to grind. If you want to learn about derivatives, I'm here to help. But there is, I mean, one way to check any of these valuations is to use Bloomberg. That is, if I am actually logged in. If I can share again, but a lot of what people use us for is that that validation. So we have to use. I don't know. Have I shared a new screen now? Can you see a new screen?
We can. Thank you.
Yeah. So I mean, that's one thing that you can do is validate it against it. But if you have a material difference in valuation, more than 50% of errors are simple interpretation of what the term sheet of the trade is. You know, the boring data entry of what the trade. You know, you see 1 million, he sees 2 million, but you've got an apple, he's got an orange. I mean, you're not really. He hasn't misvalued, but you've got a different term sheet, a different data set, and I think that. With interest rate derivatives, if you're not looking at it weekly and you're not valuing things frequently, if it's an annual or quarterly piece of work, then you're not experiencing it. So human error creeps in. So I'd say human error is the biggest defining factor. And then all these other technical things are generally second order. So one difference between systems is your bank may have multiple curves, you may have one. So that could be a source of error. Another source of error is you could have closing New York data, and they could have closing Sydney data, so the timing of the data. That's a very common one, actually, because a lot of vendors use one snapshot globally. So they just have one snapshot, and it's for all of their customers globally, especially in the Treasury Risk Management. I think there's some questions and answers, actually.
There are, actually. Can you see those, or I can read them out to you if you prefer?
So on the COVID-19, so you're on a, can you read it? So we've got the double. Oh, you're all right. No, COVID-19 is really interesting. So the question is really about credit risk. So everybody's credit risk has gone up. I just pick one at semi-random. I mean, let's go. Oh, I see what I do. If I look at the LIBOR RIS spread in US dollars, which is kind of 3-month credit risk on the banking sector. It's where banks borrow for 3 months versus where they borrow for 1 day, but you keep borrowing for 1 day. You'll see on the bottom here, it spiked up to over 100 basis points. This has put massive pressure on derivatives valuations. If you only use one curve for all of your books and you have multiple tenors, you are in a lot of trouble here. But you'll see the white line at the top, which is 3-month LIBOR. The Fed has tried to stimulate the economy by cutting rates. The problem is, for anyone who borrows against LIBOR, they haven't got the benefit of the Fed rate cuts, because LIBOR has not gone down. It went down and then it's gone back up and it's come down, but it hasn't really. So COVID-19 has put a lot of strain. Now, on the counterparty credit risk, if I go, let's have a look at a counterparty that does have, if I go CBA, equity, the probability of default can be calculated. This is the credit default swaps curve. So this green curve is the credit curve. And you will see here that there's a 5.91% probability of default for CBA. Sounds very high, to be honest. Now, this is a very standardized model for calculating probability defaults from CBA. The assumed recovery rate is 0.4. I suspect that if CBA go bust, you won't get 0.4 because they don't own anything. They haven't got. They're not BHP with big mines and hardware and stuff. I mean, they probably don't even own the building that they work in, and all their computers are leased. So if I put that down to 0.1, it hasn't changed it. Now the real question is, let's go BHP CDS. It's pushed up all of these counterparty credit risks because everybody's credit has got worse. So everybody's CVA adjustment has gone up and everyone's DVA has gone up. The only credit that's improved would be Zoom that I can think of. How would LIBOR transition to new method help in a world economic recovery? Oh, that is an interesting question. So it's kind of, I'm going to kind of grasp at something here that's a little bit of desperate hope, but I think in the recovery from this crisis, we need the real world economy to drag us out of this. This isn't going to be led by finance. Okay, we're levered, we're overly levered in my opinion. We need the real economy to boom and shine. And one one possibility is that if corporates don't borrow on LIBOR, if they can borrow on a risk-free curve, that means that when we have a crisis, they will get the benefit of that. Now I'm going to just share. I'm doing a presentation. Oh no, perhaps I won't. I was going to try and share a slide that I'm going to use next week, which is actually presenting to the FTA, the Financial Treasurers Association, and it's kind of saying that moving to these risk-free curves and moving away from LIBOR, that could be good for corporates, because every time there's a banking crisis and all the LIBORs go up, the corporate just sits back and says, I'm okay, I'm not paying more. The Fed can't, and I got the benefit. So it could help. One of the problems is that we're going to spend hundreds of billions of dollars to do this transition. And that's, I think the estimate by Accenture was $300 billion for the transition. It sounds like a lot, but it wasn't a million. And the question is whether we've got the money at the moment. Also, do you think it could lead to a bank failure? Oh, I mean, this is all subject. This is now a different topic. So I think COVID-19 is massively, massively bad for the real economy. And banks, by definition, banks are massively levered. They don't work if they're not levered. They're not trying to be. I mean, there's plenty of corporates that are cash rich. They don't need to borrow. Although a bit of debt is a good thing, so most corporates have some debt and they think that they can deploy that capital at a better internal rate of return when they borrow. Banks have loads of debt. And for every dollar that they lend, they probably borrow 90 cents. So they're by definition levered, less levered now than they were because of regulation, but they are levered. So the question is, will the bad debts from this COVID-19 will there be enough to wipe out the equity of a bank? And that, I think, is beyond my pay grade to speculate, because I'm not an expert on balance sheets, but it has to be a risk. I think in Europe, I mean, Italy, I think already a bank's gone under in Italy. And the longer this goes on, because the banks here have not provisioned against COVID yet. The $1.5 billion from NAB last week was not COVID. It was $1.5 billion for insurance and some fines. So I'm going to answer that yes, it can. It absolutely can. Unfortunately. Then the question is, who does the government want to save, and who's too big to fail? And because we saved everyone last time round, Westpac took St. George, everyone else people got bailed out and stuff like that. Can you do that in every crisis? I would imagine if the weakest of the big four struggled, the most likely scenario is they'd be taken over by one of the other three and survive. Right, I would have answered that long. There was another question, I think, that I've lost. There was another question that I didn't ask.
You can scroll down the questions, Nick. It might be.
I've lost.
You've lost it. I can read it out to you.
Yeah. It
says, I have a question regarding CVA, DVA. You mentioned that these measures in theory would sum to zero. Supposedly that entity A and B have entered into a swap and the value is positive to entity A. Does this mean that entity A books in a CVA of 1 million and entity B books in a DVA of 1 million?
That's a very good question. This is testing. I'm not an absolute expert on this. I've got a little CVA DVA calculator here. I'm going to come back to you on that. I think broadly speaking, my CVA is your DVA and vice versa. But if I'm Westpac and you are Centre Group, then in theory we should be able to value the risk-free derivative exactly and agree. And if we both use Bloomberg, we'll agree to 2 decimal places. We should be able to agree on the CDS market for both. But I could test it here. Maybe I do some analysis and remind myself of whether it's. I don't think it's an exact match. I think it's quite broad. It's quite complicated. It's still the path of. Because one of the things with CVA, DVA models when you run them both. Because here I've got CVA. I've got. Oh, I'm not sharing it. Sorry. Let me. 1 second. I'm sharing a screen, but not the right screen. Sorry. The thing, it's a path-dependent problem because when you do CVA, you're calculating the. I've still got. Oh, I know what I've done right. Hopefully, can you see my screen now?
Yes.
Right. So when you run CVA, that's my exposure on you. And DVA is your exposure on me. The bilateral is definitely not equal to the sum. And the reason being is, in the Monte Carlo, this isn't a Monte Carlo here, but in a Monte Carlo, when one institution defaults, the other part by definition stops, the contract stops. You see what I mean? So the CVA, DVA, when they're run together, are not independent. Because if one defaults, then you have to stop the other part. Now, what I need to test is, will my CVA always equals your DVA? I think it does from memory. What was the other? I've still lost all those questions. Was there another question?
I think we've come to the end of the questions. I think you've covered.
Oh, there you go.
On the...
Yeah, the bank failure one. Simply speaking, yes, it could. And the CVA, DVA there. COVID-19. Yeah.
Well, if there's no other questions, I'd just like to say thank you very much for doing this today for us. It's definitely shed a light on a subject that I needed education in, and hopefully was useful for our members as well.
Yeah, cool.
Yeah, I see you're also on LinkedIn, and hopefully, hopefully it's okay if people reach out and connect.
Absolutely, with you. Yeah. Look, my role at Bloomberg is quite broad. I do a lot of technical support. I do a lot of pre-sales and post-sales, but if you contact me with any technical question, you're not going to get a sales pitch. I'm genuinely interested in the subject. I like to chat about things. I've become a rampant LinkedIn poster on financial markets this year, really trying to stir things up. My last post, or my second last post, was actually about the negative oil price and how Black-Scholes has fallen apart. And just little thought-provocative things there. And very, very active on LIBOR transition. So if anyone wants to discuss that, I'm the kind of advocate for Bloomberg in this time zone for LIBOR transition issues, which is a massive topic.
Yeah, well, thank you very much. I guess bring it to an end, and very insightful, as I was saying, and I wish all the members a good day, and thanks again, and hopefully to see everyone at the next webinar, or when we get out of this lockdown in person. Appreciate your time, Nick. Thank you very much.
Thank you.
Bye. Thank you.